The official numbers say the U.S. economy is booming. 3% growth, record stock markets, lowest unemployment in decades. But dig beneath that national average, and something terrifying emerges. Of America's 50 states, only 16 are actually growing, 13 are treading water, and 21 are already in economic contraction. Welcome to the Wealth Forum, where we expose the patterns the headlines miss. What you're looking at isn't a recession waiting to happen. It's a recession already underway, spreading state by state, industry by industry, invisible to anyone looking only at the national picture. The cracks started in manufacturing. They spread to agriculture. Now they're reaching the financial system itself. And when one part of America's economy breaks, history shows the damage spreads fast. Here's the paradox nobody's talking about. The states that should be thriving, the manufacturing heartland, the agricultural belt, even the tech hubs, are the ones collapsing first. And the policies designed to save them are making everything worse. The real question isn't if the crash comes, it's which domino falls next, and whether your state is in the blast radius. Stick with me for the next 8 minutes. Because what you're about to learn explains why everyone from farmers to bankers to tech workers is quietly preparing for what comes next. Now, let's start with what's actually happening behind the 3% growth headline. When economists talk about the U.S. economy, they're averaging 50 completely different economies into one number. California's tech boom gets averaged with West Virginia's manufacturing collapse. Texas energy profits get mixed with Iowa's farm bankruptcies. And the result is a statistical illusion that hides the real story. Here's the truth. 22 states are experiencing economic contraction right now. Not recession risk, actual negative growth. But because the other states are growing fast enough, the national average still looks fine. It's like averaging the Titanic. Half the ship is underwater and sinking, but the other half is still above the surface, so the average elevation looks survivable. Until it doesn't. This matters because of contagion. In 2008, the housing crisis started in just 4 states: California, Florida, Arizona, and Nevada. But within months, the collapse spread nationwide. Banks that held mortgages in those states failed. Credit markets froze, and suddenly every state, every city, every household felt the impact. Today's fracture lines are worse because they're not in one sector. They're in 3 critical industries simultaneously: manufacturing, agriculture, and now the financial system that connects them all. The collapse is already here. It's just not evenly distributed yet. Let's start with the manufacturing states, places like Michigan, Ohio, Pennsylvania, the industrial heartland that once built America. For decades, manufacturing has been declining. It fell from 25% of GDP in the 1960s to just 10% today. Only 8% of American jobs. But in certain states, it's still everything. Wyoming, Arkansas, Mississippi, manufacturing is their economic core. The plan to save these states was simple. Tariffs. Make imports expensive. Push demand toward domestic production. Bring the jobs back. But tariffs require 2 things to work: cheap labor and cheap materials. And America has neither. U.S. workers won't accept 50 cents an hour. That's not negotiable. So the only advantage American manufacturers had was logistics, the best rail networks in the world, efficient ports, low shipping costs that partially offset high wages. Tariffs destroyed that advantage. Here's why. 91% of tariff costs get passed to U.S. consumers and producers, not foreign companies, American ones. So now U.S. manufacturers pay more for the steel, aluminum, and components they need. Their cost advantage vanishes. They can't compete. And they start laying off workers. Since Liberation Day, the manufacturing belt has lost over 40,000 jobs. Major steel mills in Pittsburgh are shutting down. Former factory workers are driving delivery vans or commuting hours for temporary shifts. But it gets worse. Because the second policy, strict immigration enforcement, removed the workers these factories still had. Manufacturing states relied on immigrants for 25% of industry jobs. Not because Americans won't do the work, but because rebuilding a skilled workforce from scratch takes years and costs millions. You need experienced workers to train new ones. When ICE deported hundreds of South Korean workers helping build a chip plant in Georgia, the project halted mid-construction. Similar stories across the country. Construction sites frozen, factories running below capacity. The two signature Trump policies, tariffs and immigration crackdowns, are collapsing the exact states that voted for them. Now, let's talk about what nobody saw coming. Agriculture. States like Kansas, Iowa, South Dakota generate 25% of their GDP from farming. They grow soybeans and corn, then sell them to international markets. It's been the backbone of the Midwest for generations. But in the last 2 years, crop prices have fallen by half. Part of that is competition. Brazil and Argentina ramped up production with cheaper labor. But the bigger factor is retaliation tariffs. When Trump imposed tariffs on China, Beijing hit back immediately. 25% tariffs on U.S. soybeans, corn, and pork. Overnight, America's largest agricultural buyer disappeared. Farmers are literally leaving crops to rot in fields because there's nobody to buy them. Midwest states have reported $3 billion in losses from this alone. But here's where it spirals. Even if demand existed, there's nobody to harvest the crops. For decades, farms relied on migrant labor for work most Americans won't do. Grueling, seasonal, low-paid. But immigration enforcement created farm labor shortages worse than any time in 2 decades. Some regions report 40% vacancy rates. The result? Nebraska farm bankruptcies up 30% in 1 year. Kansas and Iowa seeing 25% declines in net farm income since 2023. Family farms and major corporations shutting down simultaneously. Now here's the financial bomb nobody's talking about. Futures contracts. Farmers use these to lock in prices years in advance. It's supposed to protect them from seasonal volatility. But these contracts also lock in amounts. If you can't harvest your crop because you have no workers, you still owe the buyer. You're on the hook for produce you can't deliver. Agricultural futures have fallen 20% since 2022, the steepest drop in a decade, and margin calls are rising. That means tens of thousands of farmers are being forced to pay cash they don't have just to cover contracts they can't fulfill. Projections estimate the U.S. could lose 100,000 farms by 2030. Now, here's why this isn't just a farming problem or a manufacturing problem. It's a systemic financial problem. When farms fail, the debts don't vanish. They get passed to regional banks, credit unions, and insurers who finance them. Over $450 billion in agricultural loans are now at risk. And this is happening while household debt in service states like Illinois, Massachusetts, and Texas has exploded to 130% of income. That's thanks to a decade of near-zero interest rates. People borrowed cheaply, refinanced old debt, kept spending during slow growth. But now that era is over. Interest rates are up. Monthly payments that were once manageable have suddenly ballooned. Families downsize, businesses close. And the states with the weakest safety nets, Florida, Texas, have the worst debt problems. Credit card and auto loan delinquencies are spiking. Mortgage delinquencies just hit the highest level since 2008. Here's the connection everyone's missing. The banks that lent to farmers and manufacturers are the same banks that provide mortgages and business loans in service states. When one sector defaults, it weakens the entire lending system. And that threatens the one sector that's been holding up the national numbers, tech and AI. States like California, New York, and Washington account for 92% of U.S. economic growth, almost entirely from AI-related spending. But here's the trap. It's all built on borrowed money. Companies like Oracle operate with debt-to-equity ratios of 500%. That means for every dollar they actually have, they're borrowing 5. They're betting on inventing revolutionary, insanely profitable technology. But banks can only fund risky AI startups if they have reliable baseline income from safer investments, mortgages, commercial real estate, small business lending, the steady cash flows that let them gamble on speculation. Today, those safe bets are collapsing, mortgage defaults rising, small business failures accelerating, regional bank revenue drying up, which means the easiest place for banks to cut risk is AI startup lending, the sector propping up the entire national growth number. Here's what the cascade looks like. Manufacturing states collapse first. Layoffs spike. Regional banks in those areas start seeing loan defaults from shuttered factories. Credit tightens. Agricultural states collapse next. Farm bankruptcies accelerate. The $450 billion in agricultural debt becomes toxic. Regional lenders panic. They stop lending to anyone perceived as risky. Service states wobble third. Households with 130% debt-to-income ratios can't make payments when credit dries up. Mortgage and credit card defaults surge. The safe lending that banks depend on becomes unsafe. Tech and AI states collapse last. Banks pull funding from speculative startups. AI companies can't roll over their massive debt. Valuations crater. The 92% of growth holding up the national number vanishes. And suddenly, the 3% national growth headline flips to contraction. The recession that was already happening state by state becomes undeniable nationally. This is exactly what happened in 2008. The crisis didn't start everywhere at once. It started in 4 states with housing bubbles, then spread through the financial system to every corner of the economy. The difference today? The cracks are in multiple sectors simultaneously: manufacturing, agriculture, household debt, and AI speculation. Each one can trigger the others. The financial channels connecting every bank, fund, and business in America guarantee that when one sector fails, the shock spreads instantly. On the surface, America's economic performance looks impressive. Fastest growth in the developed world for 9 straight quarters. But it's built on a foundation more fragile than most people realize. Decades of cheap credit created the illusion of stability. Trillion-dollar deficits funded growth that looked real, but was actually borrowed. And a financial system built on leverage means even small shocks can trigger massive failures. The manufacturing collapse? Predictable when you combine tariffs with labor shortages. The agricultural crisis? Inevitable when you start trade wars with your biggest buyers. The household debt bomb? Baked in when interest rates stayed at 0 for a decade. None of this is hidden. The data is public. The trend lines are clear. But the national average masks the reality until it's too late. 22 states are already contracting. The contagion is already spreading. The banks are already vulnerable. The question isn't whether the crash comes. It's how fast it accelerates. In 2008, it wasn't exotic speculation that brought the system down. It was the most boring, reliable investment in the world: housing. Today, the setup is eerily similar. Only this time, instead of suburban mortgages, it's farm loans, factory closures, and AI companies built on borrowed money that could light the fuse. The fracture lines are visible. The dominoes are lined up. And the first ones are already falling. So, here's my question for you. Which state do you live in, and where does it sit in this cascade? Are you in a manufacturing state watching factories close? An agricultural state seeing farms fail? A service state drowning in household debt? Or a tech hub betting everything on AI speculation? Because when the contagion spreads from sector to sector, state to state, nobody escapes. The only question is whether you see it coming in time to prepare. Drop your state in the comments and tell me, are you seeing the cracks yet? Or does everything still look fine from where you stand? If this changed how you see the national economic headlines, subscribe to the Wealth Forum right now. Because understanding the difference between the average and the reality could be the most important financial insight you get this year. The crash isn't coming, it's already here. It's just not evenly distributed yet.